Hello, everyone, and a very warm welcome to this webinar to launch the International Energy Agency's new report on electricity market design. I'm Jethro Mullen, the head of the IEA's communications team, and I'm joined today by the IEA's Director of Energy Markets and Security, Keisuke Sadamori, and by Pablo Hebiacock, the head of the Renewable Integration and Secure Electricity Unit, who oversaw the work on the new report, and by the lead author of the report, Grace Henry. So, during today's webinar, Keisuke will make some opening remarks, and then Pablo and Grace will present the key findings of the report. We'll then take questions from those of you in attendance. And for the participants, we invite you to send your questions via the Q&A function in the Zoom. You can do this at any point during the presentation, and we'll also take a 2-minute break right after the presentation for you to enter your questions. And with that, I'll hand over to our Director of Energy Markets and Security, Keisuke Sadamori.
Thank you, Jethro. So good morning, and thank you for joining us for the launch of our new report, Electricity Market Design, Building on Strength, Addressing Gaps. This report examines how market design is performing today and provides guidance for policymakers as they refine market arrangements to keep markets resilient, efficient, and responsive as system needs evolve. Electricity systems are in the middle of a profound transformation. Electrification is expanding across sectors. Digitalization is changing consumption patterns. Systems are becoming more decentralized, and variable renewable generation is growing. Over the next decade, flexibility requirements are expected to grow faster than demand. At the same time, electrification in home, businesses and industry is making society more dependent than ever on reliable power systems. These shifts make real-time operations more complex and reshape how investment decisions are made. Recent years, they have shown how exposed electricity systems can be to external shocks. In 2021, the sudden and drastic reduction in Russian pipeline gas deliveries to Europe caused the European wholesale electricity prices to increase over 4 times compared with the levels in 2019. These increases were largely the result of volatile and rising gas prices, prompting over 400 emergency measures to mitigate impacts on consumers. And these pressures have made market design a topic of high political and public attention. So against this backdrop, it is important to recognize that electricity markets do not operate in isolation. They are shaped by and interact with policy, regulation, and infrastructure. Electricity market design also encompasses multiple layers, ranging from short-term markets, long-term contracts, and the complementary mechanisms. Each serves a distinct purpose, but none of them operate independently. Together, these layers bring together buyers and sellers to exchange electricity, capacity, system services, or financial contracts across the different time horizons. Around the world, the pace and scale of change is resulting in widespread reviews and reforms taking place on electricity market designs. While each market design reflects local contexts, cross-cutting themes and similarities appear across these reviews, linked to topics such as resource adequacy, long-term contracts, system flexibility, and locational signals. Ensuring these reforms are underpinned by analysis and designed coherently across market layers can help support overall system objectives. So the purpose of this report is to provide a shared understanding of where the major wholesale markets stand today. It is not a detailed technical analysis of each market, but cross-regional stocktake, accessible to both technical and non-technical audiences. By establishing common baselines, We aim to support informed discussions on market evolution and highlight areas needing further analysis and attention in future reforms. A clear finding is that short-term markets continue to deliver secure and efficient operations. Across the systems assessed, electricity has been reliably supplied more than 99.9% of the time over the past 5 years. These markets have enabled efficient scheduling, transparent price formation, and broad participations from a diverse set of resources and actors. Still, short-term markets need refinement to keep pace with decentralization and the growing shares of variable renewable generations. Greater temporal and locational granularity, as well as more flexible participation frameworks, will help unlock the full range of needed flexibility and keep short-term markets at the center of the system coordination. The long-term picture is more challenging. Forward and the future markets remain shallow in all regions, with most trading concentrated in the first 2 years. As systems shift toward more capital-intensive technologies, limited long-term hedging tools make it harder for investors to manage risk and can raise financing costs. So strengthening long-term markets is therefore essential to maintain the investment momentum. Complementary mechanisms, such as the capacity remuneration mechanisms and the renewable support schemes, are now structural features of many power systems. In Australia's national electricity market, for example, almost all capacity additions over the past decade relied on some form of government support, with similar trends in Europe, Japan, and parts of the United States. These mechanisms are here to stay, but their design matters. The poorly aligned schemes can dampen price signals and raise system costs, while the well-designed ones reinforce market efficiency and the investor confidence. The message of this report is that the electricity markets are effective tools, but their designs must continue to evolve with system needs. This means strengthening long-term markets, refining short-term arrangements, and ensuring that the complementary mechanisms align with price signals across all time horizons. As investment needs grow and operational complexity increases, the coherent market designs will be crucial. Secure and affordable electricity depends on the coordination across all layers of the market: short-term trading, long-term contracting, complementary mechanisms, and wider system governance. The report does not offer a single blueprint. Instead, it provides a structural assessment of current practices and identifies emerging gaps and priorities as systems evolve. So thank you very much for joining us, and I look forward to continuing this work together. With this, I would like to turn the floor to the Pablo Javier, Head of the Renewable Integration and Secure Electricity Unit. Thank you for your attention.
Thank you very much, Keisuke. And I'm looking forward to share some of the insights of the report together with my colleague, Grace Henry. So I would like to start by sharing some of the changes that we're seeing in markets and that act as a motivation for this analysis. And on the first hand, what we're seeing is a very clear shift in where electricity investment is flowing. Over the past years, investment has been dominated by renewables, and particularly by solar PV and wind. Today, they represent the bulk of new capacity. At the same time, investment in battery storage has been accelerating sharply over the last 4 years. And today, battery storage plays a visible role in new investment portfolios. Nuclear investment, at the same time, has also begun to increase, and this marks a notable change after years of decline across many regions of the world. Together, these technologies make up the overwhelming majority of new investment in the electricity sector for generation. But one thing they have in common, and it is that these technologies are very capital intensive, meaning that most of the costs over the operation lifetime of the asset will be paid upfront rather than during the operation. The share of capital costs for solar PV and wind, for example, is roughly twice as large as it is for gas and coal. And that means that these technologies depend on very predictable price signals in order to secure financing. Market design here plays a central role in ensuring that investors and consumers receive the cost and revenue stability that is needed to move these new projects forward. Without that visibility, many of the investments that are needed to advance electrification, to modernize the power system, will not materialize. And this is one of the main motivations for looking at the long-term role of markets. But these changes in the investment are being matched by equally important changes on how electricity systems are being operated. We see that variable renewable capacity, especially solar and wind, has grown significantly. Today, over 50% of installed capacity comes from solar PV and wind in Europe and Australia, and over a quarter in Japan and the United States. Now, the output of these technologies depends on the weather and the time of the day, and can change very rapidly over short periods of time, requiring more flexible operation of the power system. At the same time, batteries and variable renewables are far more distributed geographically across the power system than traditional power plants that used to be centralized. And that means that power systems today must coordinate a very large number of assets operating in more locations and changing their output much more quicker than in the past. These operational changes increase the importance of having markets that in the short term can identify, can price, and can mobilize that flexibility at the right time and at the right location. Short-term markets here play a central role in guiding these operational decisions by translating the real-world system conditions into price signals that allow all of the assets to act in the interest of the system. In order to keep supporting secure and efficient operations, what we do see is a need to continue the evolution of short-term markets in order to refine their temporal and locational resolution. In that way, these short-term markets can keep pace with the changing reality of the system. But a very important role of short-term markets is supporting secure system operation. And this role becomes very clear when we look at how they performed over periods of extreme stress. During the 2022 energy crisis that was triggered by the Russian invasion of Ukraine and the consequent decline of pipeline gas exports to Europe, wholesale gas prices rose in Europe to unprecedented levels. Short-term electricity markets reflected these conditions, and due to the role of gas for providing flexibility in the continent, they provided clear signals of scarcity across the system, hour by hour. These signals worked together with policy measures in order to prompt supply-side and demand-side responses that ensured the balance of the system. We saw a broad set of responses: shifts in consumption patterns, more use of storage, adjustments in industrial demand, and changes in the dispatch of flexible generation across interconnected regions. Even during a year of extreme stress that was characterized by widespread policy interventions, we saw that market incidents remained rare. In the main European markets during this period, incidents occurred less than 0.3% of the year. And even more so, these incidents were linked to IT issues rather than pure market function errors. These experiences reinforces the need to preserve the core principles of short-term market design as we continue to refine them. Now, I would like to pass on to my colleague Grace, and she will share some of the findings when we look at long-term markets and complementary mechanisms.
Thanks, Pablo. Long-term markets include contracts that allow electricity buyers and sellers to lock in prices in advance. This provides predictability of future prices, which is particularly important in today's context, given the short-term market price volatility we've seen and the increasing capital-intensive nature of investments that Pablo highlighted. However, across most regions, these markets suffer from low liquidity, which makes it much harder for participants to find the contracts they need to manage price risk. Looking at forwards and futures markets, which are the most common types of long-term markets, Only Germany exceeds the typical benchmark used to assess if a market has sufficient liquidity. When we dive into this further, we see that even for the markets which have higher levels of liquidity, when we look at the time horizon of the trades, most occur within just 2 years, which is far less than the typical 10 plus years needed to support capital-intensive investments. PPAs, or power purchase agreements, are another type of long-term contract that can be used to manage price risk. These are bilateral, bespoke contracts that can be tailored to the needs of buyers and sellers. As such, PPAs are increasingly being used to provide longer-term price stability than what forwards and future markets can currently provide. We see this in the rapid growth of PPA uptake for renewable capacity additions, although overall volumes remain relatively small. They cover only 3% of renewable and storage installed capacity in Europe and around 10% in Australia and the United States. While PPAs can offer longer protection against price risks, they are not widely accessible. Most PPAs are signed by large buyers, with smaller participants facing barriers from the cost, complexity, and credit requirements associated with engaging in bespoke bilateral contracts. PPAs are also not always well integrated into market frameworks, which can negatively affect market efficiency and transparency. While PPA volumes remain relatively small, this is not causing major issues at the moment, but as the volumes continue to grow, this is something that needs closer attention, ensuring alignment with market frameworks to avoid these unintended consequences. Overall, what we found is that long-term markets are falling short in providing broad and effective risk management opportunities to market participants, which are particularly needed to support new investments. As Keske outlined at the start of this webinar, markets do not operate in isolation. Some policy objectives, such as reliability or emission reduction, cannot always be achieved through markets alone. In these cases, complementary mechanisms can provide targeted support to bring forward new investments and maintain essential existing capacity. We see this occurring widely for resource adequacy. By providing a stable revenue stream alongside market earnings, capacity remuneration mechanisms can help prevent premature retirements of essential resources and support timely investments in new capacity. The growth in these mechanisms over the past 2 decades reflects the increasing challenges markets face in delivering secure electricity supplies as aging thermal units retire and variable renewables expand. In terms of decarbonisation, targeted complementary mechanisms can help increase both the pace and scale of investments required to support policy goals. Across the markets we analysed, 90% have investment support schemes for advancing low-carbon generation, with some examples such as Australia's NEM, where almost all new investments in the last decade benefiting from some form of complementary mechanism. Overall, complementary mechanisms have become a structural feature of electricity markets, but the design of these mechanisms must be carefully coordinated with short-term and long-term markets to ensure alignment and avoid unintended consequences. To conclude, electricity markets are effective tools, but their designs must continue to evolve with system needs. Although each market design is context-specific, we find commonalities across designs that point to 3 main recommendations. First, as Pablo highlighted, short-term markets have been largely effective in supporting secure and efficient operations. But as generation becomes more variable and distributed, further refinements can improve how well markets reflect the time and locational value of electricity, and also unlock additional value through enabling the full participation of all resources. Next, Long-term markets show more structural gaps that must be addressed to strengthen risk management and support investments. Key priorities include improving liquidity, broadening access, and bridging the gap between buyers and sellers' hedging needs. Finally, complementary mechanisms play an important role and should be carefully designed to integrate them effectively with short and long-term markets. They should reinforce short-term price signals while complementing existing long-term markets and targeting specific gaps that markets cannot deliver alone. Now I'll hand back to my colleague Jethro, who will take it from here.
Thanks a lot, Grace. And thank you all for the presentation, very informative. And we now have some time to take some questions from those of you participating in the webinar. So we invite you to send the questions through the Q&A function in the Zoom if you haven't done so already. And we're just going to take a 2-minute break to give you a chance to enter your questions, and we'll be right back. Hi everyone, welcome back. I've got my glasses on, which means it's time for the questions, so I can make sure I can read them on the screen properly. So thank you all very much for the questions so far. We'll get through as many as we can, and several coming in on different themes. We have one on, in practice, what improvements could make short-term markets even better. Another one on what is the different role of forwards, futures, and PPAs in long-term markets. And then also another question on PPAs, how is a long-term PPA treated in the design of a market? And then also a couple of questions about Europe and Europe's market design. There has been increasing talk on the regionalization of capacity markets at a European level. Do you see this as a realistic implementation? And if so, what would be the challenges to face? And then another one, what are the specific challenges of market design in Europe, since it's the only geographical zone in the benchmark to encompass several countries? How can disaligned interests between countries be managed? And sorry, there's one more in Europe that maybe I'll put in and then see how you want to address these different elements. Against the backdrop of large-scale integration of variable renewable energy into the power grid, which is more important for the development of the European electricity market, strengthening cross-border grid interconnections or enhancing local grid development? Grace, maybe do you want to have a go at the PPA related questions, PPA versus forwards, futures in long-term markets, and then we'll move on to the next ones.
Yeah, sure. So in terms of, and thank you everyone for your questions, it's great to see this engagement. In terms of the report, we've bundled together forwards, futures, and PPAs under medium and long-term contracts. And in terms of different roles, as we said, PPAs can offer these longer-term contracts. So you might see contracts 10 plus years, which can provide that forward stability and predictability of prices, which is particularly important role we see in terms of large industry in having that predictability of future electricity prices. So on the buyer side, PPAs have quite an important role for large industry. But as we said, and in terms of the investment side, it's also quite useful. But as we said in the analysis, PPAs aren't always widely accessible to all participants. And we also note that there are some sort of limitations in terms of sometimes these PPAs aren't very transparent, which has impacts on price formation and price transparency. And then in terms of market efficiency, so if these participants are receiving, if they're not participating in the short-term market and they're not responsive to short-term market signals, we start to see a large share of generation that isn't operating in line with system needs. So this is where we see, I suppose, this tension and I suppose this gap where we really need to increase, strengthen and increase the robustness of forwards and futures markets, extend those time horizons beyond 2 years so that participants have these long-term instruments available to them and that they're working with the system as well. So the report goes into it in more detail. PPAs are, because they're bespoke bilateral agreements, obviously the terms in which they're agreed between the participants is something agreed between them. So it's something that, we don't provide specific recommendations on contract terms, but we note that as a system, forwards and futures have a key role, and we need to make sure that we don't overlook that. Do you want to add anything, Pablo?
No, that was excellent.
So maybe Pablo, if you want to speak a bit about the European element and what are the challenges, and this idea of markets across the different countries.
Definitely, thank you so much, and it's really great to see so many questions coming in. I'm going to try to put some of the themes here on the short-term and the European markets together, because it is really true that what we've seen, and particularly during the crisis, is that one of the great strengths of the European market was the fact that it is an interconnected power system that operates together and that allows the support and the efficiency to flow through cross-border across nations. Now, even though the question here says that it is the only market that covers many countries, in this case, it is true. At the same time, we need to remember that in markets like the United States as well, you go across different regions and across different states, which also may have different levels of incentives. So there are many similarities that can be taken and lessons in terms of guiding principles that can be applied. In terms of the development of the integrated market in Europe, the capacity dimension is quite important. And one of the strengths of Europe is that interconnectedness, but it gets diminished when you see significant differences in market design across borders. The reality is that if you look at the European power system grid, it is extremely hard to figure out where the national boundaries are. And that means that maintaining the ability of the power system infrastructure to operate as efficiently as possible benefits a lot from finding alignment across neighboring countries in Europe, while recognizing that, of course, different countries have different policy objectives and different preferences. In the case of the development of variable renewable energy into the power grid, this is not specific to Europe, I think that it's quite hard to be able to say, should we strengthen cross-border grid interconnections or enhance local grid connections. We are at a point in time in which the growth of the importance of electricity, the growth of demand, the growth of distributed energy resources, and the benefits that can come from more interconnected power systems means that we are in an everything, everywhere, all at once kind of situation in which you do need significant strengthening of grids at the local system level, but also you can reap significant benefits by increasing interconnection, particularly in those systems where these interconnections are quite weak. You will find that in many states in the United States, or in the case of Japan and even in Europe, the places where you have significant demand centers are not always the places where you have a variable renewable energy resource potential, and therefore it is important to interconnect these power systems to make sure that electricity can flow in time to where it is needed. So these are some of the topics that I bring here. And finally, there's one question that I want to take related to the bidding zones, which is quite particular to Europe as well. And while we do recognize that there's a lot of political sensitivity and questions of distributional effects when you revise the bidding zones, the guiding principle remains very true. And it is that the ability of a market, a short-term market, for example, to fulfill its role in creating efficient allocation of resources, in maintaining that secure dispatch, depends on its ability to be closely related to the physical reality underneath. And therefore, we do see it as extremely important to revise bidding zones, to revise that geographical resolution, to make sure that when we identify systematic constraints, for example, in transmission networks, this also gets represented at the market design layer in order to ensure that those two layers remain as closely aligned as possible. So get back to you, Jethro.
Great, thank you, Pablo. So a couple of questions, I think, kind of around the role of regulators and also government intervention. One of them is, what are some mechanisms that have been trialed to address the differences in durations desired by buyers and sellers of long-term hedging instruments? What is the role of regulators on this issue? And then another regulatory question, you mentioned that forward market liquidity should be strengthened. Do you see more or less government or regulatory intervention as the way to achieve that more efficiently? And then I'm just making sure we haven't missed too much in terms of other questions. You took the one on bidding zones. There was one on prices. What market design reforms can be implemented so that European industries can pay lower electricity prices? I think we're covering the main ones there. Grace, the regulatory elements, is that something you could?
Sure, I can take that one. Some really good questions coming through here. So what I didn't go into detail in the presentation was that we see that there's this mismatch in hedging needs between buyers and sellers. So in terms of long-term contracts. So many buyers face increasing risk if they engage in contracts over longer durations. And so that can include retailers where maybe their future retail contracts are uncertain. And it can also include other industries where they're unsure how the wholesale market prices will evolve. And to minimize their risk, they're less willing to engage in these long-term contracts beyond, for instance, 2-3 years. That's opposed to the seller side, who needs these long-term contracts to be able to get financing from banks and create, investable projects. So we have this mismatch, and in Australia, the national electricity market is undergoing a review of the wholesale market settings, and they've described this mismatch as a tenor gap. And I'd say it's somewhere where market designs are still evolving and we're still working out the best way to approach this tenor gap. But in the NEM review, they're looking at ways where the government can play a role in terms of you can have a central entity which buys some of these contracts across the longer time horizons, and then closer to delivery, they recycle those contracts back to the market. So what we see is that the government is taking on a risk in those later years where some market participants are unwilling to take on that risk, and then recycling it back to the market. So it's a bit of a closed loop. And we're yet to see this in practice. It's a proposal at the moment, but that's one innovative way that you can see the government playing a role, and really playing a strategic role in terms of what risk does the government take on. And so that's a thing that we'll be watching closely to see how that evolves.
Great, thank you, Grace. Pablo, on the prices, maybe?
Yeah, definitely. I mean, I'm happy to see this question, because not talking about affordability and competitiveness, which is really at the heart of many of the discussions of the power sector today, would be a shame. And there's one maybe strong message to start with, and it is that market design can help with affordability, but cannot solve the issue by itself, because often what we see is costs and competitiveness issues are not related to market design artifacts, but actually to physical realities underneath, and that those physical realities need to be addressed. For example, dependency on imported fossil fuels in some markets can produce exposure to external market factors, so on and so forth. Now, from the market design perspective, there's two main ways in which one can approach the cost question, and therefore the price formation question. The first one is reducing costs through efficiency. And that means that operating your power system and utilizing the right resources at the right time to find the cheapest solution at every point in time to operate your power system is one way to reduce the total price and increase competitiveness. And that requires coordinating thousands of assets across countries, across continents, in all of the markets that we reviewed. Short-term markets play a very important role here, and that is the ability of the short-term market to provide those price signals to align these thousands of actors into operating in an efficient manner. We mentioned it before, but that geographical and temporal resolution improvements are essential here, because they really allow the system to reduce congestion costs, to provide market outcomes that are physically possible, and therefore to support the reduction of costs. A second dimension on how we can reduce these costs is related to risk. And as we know, risk tends to become increased risk premiums and therefore higher costs. And long-term markets and complementary mechanisms play a significant role here. On one hand side, being able to have liquid long-term markets as well as PPAs flourishing that will reduce the cost of capital of new project developers is a good way of ensuring that these projects come into the market with lower risk premium, and therefore the cost is reduced for consumers. Another aspect of this has to do with the complementary mechanisms, and here we see them a bit as a double-edged sword. On one hand side, they can really play an important role on de-risking new projects, on ensuring security, and reduce that dimension of costs. On the other hand, the design of these complementary mechanisms is extremely important, both in how they achieve their objective by themselves, but also on how they interact with the short-term and the long-term markets. If these complementary mechanisms are ill-designed, what we could see, and it's something mentioned by one of the questions here, is, for example, increased cost for consumers due to oversupply or lack of efficient use of resources by, for example, not taking advantage of competition. At the same time, if they're designed not considering how they will interact with the short-term and long-term markets, it might be that they actually hinder the liquidity of long-term markets, or that they reduce the operational incentives in short-term markets that are so essential for reducing the costs by improving efficiency. So, summing up, we do see a very strong role for market design in supporting affordability, but we need to keep in mind that there's also a physical reality underneath that is driving many of the prices and costs that we see. Back to you, Jethro.
Great, thanks, Pablo. And I think you kind of wrapped in one of the other questions that was about how to avoid support schemes resulting in short-term oversupply. I think just one last question was, if I'm just checking, sorry, a question on negative prices and ways to address this. So could you elaborate a little more on the occurrence of negative prices and ways to address this issue? And then one question on what next for this work at the IEA, building on this report. What do you plan to do with it? Are you going to engage with governments on it in different regions? So yeah, is that negative prices? Is that one for?
I could take both of them maybe.
Okay.
And feel free to complement. in terms of negative prices, you will see that these negative prices that used to be a bit of a special occasion once in a while have become really an everyday reality in many systems. And we don't see negative prices themselves as an issue, but as a very important red flag of things that are happening. One of those things that are happening is really lack of flexibility in power systems. Sometimes this can be linked to, for example, grid congestion, but sometimes this can also be linked to market design issues, and particularly when we're looking at how do complementary mechanisms maintain or reduce these operational incentives. And what do I mean by this? We have seen that certain complementary mechanisms for supporting renewables, for example, in their design have managed to shield this generation from the signals of the market, meaning that they have no incentive to operate flexibly. This creates an issue because that means that in periods of time where, for example, there is abundant generation and very limited supply, these generators do not see any incentive to change the operating pattern in a way that would benefit the system, or even worse, in some cases, operating in the way in which the system will receive benefit would result in a worse business case for them. So that alignment between complementary mechanisms and the short-term markets results in increased negative prices or deeper negative prices. Now, as we move ahead, there's quite a bit of activity around this topic, of course. We're going to be working quite closely with our member countries to share, to discuss. And next week, we're going to be hosting a workshop where we're going to be traveling to Tokyo, together with the government of Japan, holding a workshop there with industry and academia to discuss how do these findings can guide the work in Japan. And we expect similar activities with many of our member countries. As of next year, beyond the dissemination, this is a topic that is very close to the heart of the IA's mission, both from the perspective of competitiveness and security, and we expect to see more analysis, be that regional deep dives, be that work with some of association countries, as well as looking at other parts of the market that are extremely important, but that were not part of this analysis, as for example, retail markets and the role that they can have on efficiency, security, and affordability for consumers.
Great. Thank you very much, Pablo. I think we've covered all the main questions that we received. So it just remains for me to say thank you very much to Keisuke, Pablo, and Grace. And a big thank you to all of you participating in the webinar for the great questions. A quick reminder that the report on electricity market design is freely available on the IEA website to read in full. So do take a look if you haven't done so already. And thank you and goodbye.